All right, let's jump right into this explainer and absolutely crush the financial gauntlet of investment returns and tax rules. Look, if you're gearing up for your Series 7, you already know the exam loves to test not just what an investor earns, but exactly how the IRS swoops in to take its slice. So, we are breaking down the tax traps, the formulas, and the sneaky gotchas that are for sure going to show up on test day. Real quick before we get into the weeds, this explainer is brought to you by CertFuel. If you want to lock this material down fast, check out certfuel.com for a full Series 7 course. They've got adaptive study quizzes, smart flashcards, and unlimited practice exams that are weighted just like the real thing. It's exactly what you need to pass, zero fluff. Okay, to help us navigate all these crazy rules, meet Carla the customer. Carla is our, let's say, highly chaotic, super demanding investor. Her core philosophy, I want maximum returns, zero taxes, and I want it all yesterday. She's about to drag Riley the rep, our super diligent broker, through an absolute gauntlet of complex tax treatments you have to memorize. Let's see how Riley handles the chaos.
Starting off with Section 1, Return of Capital Reality. First up, let's tackle a concept that constantly trips people up, and that's return of capital. Now, a return of capital is a distribution that is not from earnings or profits. It is simply a return of your own original investment. Think of this like, eating your own emergency pizza you hid in the freezer. You aren't gaining any new calories from the delivery guy, you're just depleting your original stash. Because it's your own money just coming back to you, the IRS says, hey, it's not taxable income when you receive it. But there's a huge catch.
Riley the rep sits Carla down and shows her the math here. Every single time she gets a return of capital, her cost basis steps down closer and closer to zero. For example, if she buys 100 shares at $50, her starting basis is $5,000. When she gets a $500 return of capital, yeah, it's tax-free, but her new basis drops to $4,500. Another $500 comes back, basis drops to $4,000. It just keeps stepping down. Okay, pause the explainer right here. I want you to actively think about this for a second. What happens when Carla's cost basis finally hits $0 and she gets another distribution? Answer it in your head before Sam, the supervisor, catches you. Bam! Here is your first massive exam trap. Once that cost basis hits zero, the free ride is totally over. It is no longer tax-free and becomes taxed as a capital gain. This catches so many test takers who just assume return of capital is magically tax-free forever. It is not. Once you've pulled out all your original money, every subsequent dollar is considered a gain. Burn that one into your brain. Let's move right along to Section 2, Munis, Taxes, and Yields. We've got to compare these side by side because the exam absolutely loves testing your ability to tell them apart. On the left, we have corporate bonds. The interest here, fully taxed as ordinary income at both the federal and state levels. Bummer. But on the right, municipal bonds. Munis offer that beautiful triple tax exempt advantage. They are generally exempt from federal taxes, and if Carla buys a muni issued in her home state, it's exempt from state and local taxes too. It's a sweet deal. And this brings us to exactly how we measure that advantage, the tax equivalent yield formula. To actually compare a tax-free muni to a taxable corporate bond, you take the muni yield and divide it by 1 minus the investor's marginal tax rate. This formula is exactly how Riley proves to a very highly taxed Carla that munis are actually her best friend. Let's run the numbers to see it in action. Say Carla is in a high 32% tax bracket, and she's looking at a 4% yielding municipal bond. She might scoff and think, 4%, that sounds super low. But Riley busts out the formula. 4% divided by 1 minus 0.32, which is 0.68. Do the math, and that gives us a massive 5.88% tax equivalent yield. Meaning, Carla would literally have to find a fully taxable corporate bond paying 5.88% just to match what she takes home from that little 4% muni. The higher her tax bracket goes, the better that muni looks. But wait, Sam the supervisor is stepping in and waving a giant red flag. Exam trap, private activity bonds. If a muni is a private activity bond, meaning it's financing some non-governmental project, that interest might trigger the alternative minimum tax, or AMT. So spoiler alert, not all munis are completely tax-free for everyone. Always watch out for the letters AMT hiding next to private activity bonds. All right, diving into Section 3, Interest and Dividend Rules. The big thing here is how obsessively the IRS watches the calendar. 60 days. That is the magic number to get those sweet, highly preferential long-term capital gains rates on qualified dividends, which, by the way, can be 0%, 15%, or 20% instead of your brutal ordinary income bracket. Carla has to hold the stock for more than 60 days during a very specific 121-day window around the ex-dividend date. If she misses that holding period by even a day, she's paying ordinary income rates.
Here is another crucial side-by-side comparison you need to lock in. U.S. Treasuries versus municipal bonds. Guys, these are the exact opposite of each other. U.S. Treasuries are taxed at the federal level but exempt at the state and local level. Munis, like we just talked about, are exempt at the federal level and often exempt at the state level. The exam is absolutely going to try to cross these wires in your head. Just remember, Treasuries pay Fed, munis don't. Okay, pause the explainer again. I'm putting you on the spot. Let's say Carla buys a stock and she sells it exactly 1 year after buying it, right on the dot on the 1-year anniversary. Is this a short-term gain or a long-term gain? Watch out, it is a huge exam trap. It is a short-term gain. The rule for short-term capital gains, which are taxed at those higher ordinary income rates, is 1 year or less. The or less is the trap that gets people. An exact 1-year hold gets slapped with short-term taxes. You have to hold it for more than 1 year to get long-term preferential rates. The IRS does not hand out participation trophies, guys. You need 1 year and a day. Section 4, Total Return Demystified. Let's tie all of Carla's chaos together into the ultimate benchmark. Total return is the absolute, complete measure of investment performance. It's the gold standard benchmark. Here's how you do it. Step 1. Add up your income. That means all the interest and dividends. Step 2, add your capital gains, or, subtract your losses. Step 3, divide that entire giant sum by your initial investment. It tells you exactly how hard your money actually worked for you. Okay, pause the explainer one last time. Think about this logically for a second. Do you only count the gains if Carla actually sells the security? Like, if she just holds it and the price goes way up, does that count in her total return? Sam, the supervisor, is back to point out the trap. Unrealized gains absolutely count towards total return. You do not need to sell the security for the gains to be included. If Carla buys at $50 and it shoots to $60, that $10 gain is part of her total return, even if she is still holding the paper. Total return measures the performance of the asset, period. All right, pulling all this together, let's hit Section 5, the rapid-fire exam recap. Lock these top testable points into your brain right now. Number 1, when return of capital drops your cost basis to 0, any further return is a capital gain. Number 2, private activity bonds hide AMT risks. Number 3, you have got to hold a stock for more than 60 days to get those preferential rates on qualified dividends. And number 4, treasuries are federally taxed but state exempt, which is the exact reverse of munis. Before you close this explainer, I've got a quick memory challenge for you. Grab a piece of paper right now and prove you can write out that tax equivalent yield formula from memory. What is the muni yield divided by? That's right, 1 minus the marginal tax rate. Make sure you've got that down cold. But hey, just wait until Carla tries to claim a capital loss on a stock she literally just bought back yesterday. Yeah, that triggers the dreaded wash sale rule. We are going to dive into that total nightmare next time. Keep studying and stay totally focused.